Hello, everybody. Welcome back for another segment of Cup of Joe. I am Joe Gallimore, the Director of Investment Management with Argent Bridge Advisors. Today, I want to take a step away from talking about the index numbers and talk about two general concepts in investing. Those two concepts are comparing a portfolio to what you hear in the news and then herd mentality. So, first, when financial media talks about the market, to what exactly are they referring? And is this a fair comparison to what's in your portfolio? Well, let's consider the S&P 500, which is the most widely used barometer of US stocks. First of all, that index pretty much only represents large cap US stocks, which is only a part of a diversified equity portfolio. But second, and more importantly, the index is constructed using what's called a market cap weighted methodology, which simply means that the larger a company is, the greater its representation in the index. Many indexes use this methodology and it has its pros and cons. But what has ended up happening with the S&P 500 is that it's narrowed and now disproportionately represents a small subset of stocks. The telling stat for this is that the top 10 stocks in the S&P 500 make up over 30% of the market cap weighting of the index. And 7 of those stocks are technology stocks. So unless your portfolio is super concentrated, which we at Argent Bridge would never let happen, you should expect your return to look nothing like that of a market cap weighted index. There's an old adage in investing that diversification is the only free lunch. And as all of you know, a foundational tenet of our philosophy here is to keep your portfolios well diversified. So make sure that when you hear updates on the market, on the radio, on financial media, that you're mindful of what exactly is implied with what they're telling you, because it often is not an accurate comparison to your portfolio. And this awareness will do wonders for your sanity. And next, I want to touch on a concept rooted in behavioral finance called herd mentality. You may have already heard this term, but our spin on this focuses on when you feel compelled to participate in investments that are getting the most noise. So that's right, we're talking about FOMO, the fear of missing out. FOMO is a natural reaction that we all have, typically in thinking that there's safety in numbers, or in this case, safety in good decision making in numbers. But remember, internet stocks were the craze in the late 90s until they weren't. And real estate speculation was all the craze, was a can't miss in the 2000s until it was a can't miss. And it seems like right now, these past 18 months, Tesla has been a must own in every portfolio. But you know who doesn't own it? A large percentage of institutional investment strategies. JP Morgan recently published data showing that for the S&P 500 index, the higher the ratio of the index price relative to the earnings of all the companies inside it, the lower the returns are for the next 5 years. So currently, that price to earnings ratio sits at 20.3, which is a little over its long term average. The PE ratio of those 10 stocks that we mentioned earlier is 28.6. And the PE ratio of Tesla right now is 341. So, one thing to keep in mind when you find yourself experiencing FOMO is that you don't really know what the person next to you owns. And if you're listening to pundits, you don't really know how fleeting their level of conviction might be about what they're speaking. And rarely do any of these parties share their exit strategy with you. So acting on FOMO, we think, is a little like saying that the herd knows better than my investment plan. And we just like to remind you to stop and think about which part of that sentence that you have more confidence in. So if you have any questions about anything we've discussed, please let us know. We are happy to discuss and happy to answer. And thank you for listening to Another Cup of Joe. Take care.